$5 trillion, vanished from paper promises, and quietly reappeared in gold and in silver. This did not happen by accident. It happened because a decision was made in a room you were never invited to. And by the time most people understand what occurred here, it will already be too late to react. What you're about to see is not speculation. It is a pattern, one that has repeated itself throughout history, right before every major currency has lost its power. Stay until the end, because the final part of this story is the part they hope you never connect. Welcome back to Precious Metals Intelligence, the channel dedicated to helping serious, thoughtful individuals understand what is truly happening beneath the surface of the global economy. If this is your first time here, thank you for trusting a few minutes of your time with this analysis. And if you would be so kind, let us know in the comments where in the world you are watching from today. It is always meaningful to see how far this conversation reaches. It began with a number, not a headline, not a press conference, just a number buried inside a routine government report, the kind that most people scroll past without a second thought. The United States Treasury had quietly doubled the size of its long-term bond buyback program. Before, it was purchasing close to $2 billion of older bonds during each session. Now, without much explanation, that figure had jumped to $4 billion per session. On the surface, this sounded like nothing more than technical housekeeping. The official reason given was simple enough. The government wanted to support long-term bonds and keep its own borrowing costs under control. To most people, this explanation felt reasonable. It felt boring, even. And boring things rarely make the news. But a small group of people did not see it as boring at all. Institutional investors, the kind who manage billions of dollars for pension funds, insurance companies, and sovereign wealth funds, read this move very differently. They did not see a government simply managing its bond market. They saw a government stepping in to prop up demand for its own debt. This distinction matters more than it seems. A healthy bond market does not need the government to buy back its own debt at a larger and larger scale. When a government must intervene like this, it often means fewer outside buyers are willing to hold that debt on their own. And when that happens, serious investors begin asking themselves a very old question, one that has been asked in nearly every era of financial history. If the government has to support its own debt, what does that say about the value of the currency behind it? This is not a new pattern. It has appeared again and again throughout history, though it rarely looks the same twice. In earlier centuries, kings would quietly reduce the amount of silver or gold in their coins, hoping no one would notice the difference. In more recent history, governments have printed more currency, expanded debt, and adjusted policy to manage short-term pressure, often while reassuring citizens that everything remained stable and under control. Each time, the pattern looked ordinary from the outside. Each time, a small number of experienced observers noticed the shift long before the general public did. And each time, by the time everyone else understood what had happened, the value of money itself had already quietly changed. This is why the recent bond buyback decision caught the attention of serious analysts. It was not the size of the number that concerned them. It was what the number represented. The United States government now carries a national debt that has crossed $40 trillion. That is a figure so large it becomes difficult for most people to truly picture it. To put it simply, it means the government owes far more than it earns in a year, and that gap continues to grow. When debt reaches this scale, managing it becomes harder every year, not easier. Interest payments alone begin to compete with other national priorities. And when a government must intervene directly in its own bond market just to keep borrowing costs from rising too quickly, that is often viewed as an early warning sign, not a solution. Global investors understood this. They did not panic. They did not make loud statements or dramatic predictions. Instead, quietly and gradually, some of the world's largest and most cautious pools of capital began shifting their attention elsewhere. Not toward another currency, not toward another government bond, but toward something that has outlasted every currency and every government in recorded history. They began looking again at gold, and alongside gold, they began paying closer attention to silver. This shift did not happen overnight, and it was not driven by fear or emotion. It was driven by pattern recognition built from decades, and in some cases, centuries of financial history. Those managing large amounts of capital tend to move carefully and quietly, long before ordinary investors notice anything at all. What began as a small technical decision inside a government bond program had quietly become something much larger. It had become the opening signal in a much bigger story, one that connects directly to trillions of dollars now flowing into precious metals. And this is only the beginning. Because once trust in a currency starts to soften, even slightly, it rarely stays contained to one part of the financial system. It begins to spread, slowly and quietly, into every corner of the global economy. History does not repeat itself in exact detail, but it often rhymes in ways that careful observers learn to recognize. And for those who study money closely, a very old rhyme was starting to play once again. Economists have a name for what happens when a government or a ruler quietly reduces the true value of its currency while still expecting people to trust it the same as before. They call it debasement. It sounds like a complicated term, but the idea behind it is simple. It means making something worth less while hoping no one notices right away. This is not a modern invention. It stretches back thousands of years. Ancient rulers once mixed cheaper metals into their gold and silver coins, hoping the coins would still be accepted at full value. For a while, it usually worked. People kept spending the coins as if nothing had changed. But over time, prices began to rise, trust began to fade, and the truth eventually became impossible to hide. The tools have changed since then, but the pattern has not. Modern governments do not need to melt down coins. They can simply create more currency, expand debt, and adjust financial policy in ways that quietly reduce the purchasing power of money already in circulation. The coins look the same, the paper bills look the same, but what that money can actually buy over time slowly shrinks. This is the exact pattern that experienced investors began to notice again. A government carrying more than $40 trillion in debt, a central bank system stepping in to manage bond markets more actively than usual, and a currency that, while still the most widely used in the world, was showing small but noticeable cracks in its long-term strength. None of this meant collapse was coming. It rarely does, and serious analysts are careful not to suggest otherwise. But it did mean something important. It meant confidence was shifting, even if only slightly, and even if most of the public had not noticed yet. This is where gold and silver enter the story, not as trendy investments, but as something far older and far more stable. For thousands of years, across nearly every civilization, gold and silver have held value in a way that paper currencies never could. They cannot be printed. They cannot be created out of thin air with a policy decision. Their supply grows slowly through mining and production, not through a government meeting. More importantly, gold and silver carry something that modern currencies do not. They carry no dependence on anyone else's promise. A dollar is valuable because people trust the government behind it will honor its value. A bond is valuable because people trust it will be repaid. Gold does not ask for that kind of trust. It simply exists, and it has held meaning to human beings for longer than any government currently in power. This is precisely why, during moments when trust in paper currency begins to soften, large and experienced investors quietly begin shifting a portion of their capital toward metals. Not because they believe the dollar will disappear, but because they understand that protecting wealth means preparing for uncertainty before it becomes obvious to everyone else. And this shift rarely begins with everyday investors. It begins much earlier, inside the offices of pension funds, insurance companies, sovereign wealth funds, and central banks themselves. Now, these are patient, careful institutions. They do not react to headlines. They react to patterns building quietly beneath the surface, patterns most people are simply too busy to notice. By the time gold and silver prices move sharply enough to make headlines, these larger institutions have often already been positioning for months, sometimes longer. The public reaction comes later. The institutional reaction comes first, quietly and without announcement. This is what makes the current moment so important to understand. The $5 trillion shift now appearing in gold and silver markets did not begin with excitement or speculation. It began with something far more serious. It began with a slow, quiet loss of confidence in paper promises, and a return to something that has never needed anyone's permission to hold value. The debasement trade, as analysts call it, has returned. And history shows that once this pattern begins, it rarely reverses quickly. It tends to build slowly at first and then all at once. Rarely does a major shift in financial markets happen because of a single cause. Usually it happens because several forces arrive at the same moment, quietly reinforcing one another until their combined weight becomes impossible to ignore. This is exactly what analysts began to observe as gold and silver started their remarkable climb. The first force involves the value of the dollar itself. Gold and silver are priced in dollars around the world, which means their price is directly affected by how strong or weak the dollar happens to be at any given time. When the dollar weakens, it takes fewer units of other currencies to buy the same amount of gold or silver. This makes precious metals more attractive to buyers outside the United States. Recently, as economic data cooled expectations for further interest rate increases, the dollar pulled back from its earlier highs. That single shift, on its own, made gold and silver more appealing to buyers across the world. The second force involves something called real yields. This term simply refers to the return an investor earns after accounting for inflation. When real yields are high, holding bonds becomes more attractive because investors are being paid well to wait. But when real yields begin to fall, the appeal of bonds fades and the appeal of gold begins to rise. Gold does not pay interest. It never has. But when the alternative, holding bonds, offers less and less benefit, the cost of holding gold instead becomes smaller and smaller. In simple terms, gold becomes easier to justify holding when everything else offers less in return. The third force is perhaps the most significant of all, and it has been building quietly for years. Central banks around the world have been purchasing gold at a pace not seen in decades. This is not driven by short-term trading strategies. It is driven by long-term national policy. Many countries have grown increasingly cautious about holding too much of their reserves in a single currency, particularly the US dollar. Back in the early 2000s, the dollar made up roughly 72% of global currency reserves. Today, that number has fallen to around 57 or 58%. This slow, steady decline reflects a broader shift often referred to as de-dollarization, a gradual move by nations to diversify away from dependence on any single currency. When central banks buy gold, they do not behave like typical investors. They are not trying to time the market or chase short-term profits. They buy steadily, regardless of price, because their goal is long-term financial security for their nations, not short-term gain. This type of buying creates something analysts often describe as a price floor. Because central banks continue purchasing gold no matter how prices move day to day, it becomes increasingly difficult for gold prices to fall sharply and stay there for long. What makes the current moment especially important is that these three forces, a weakening dollar, falling real yields, and historic central bank buying, are not happening one after another. They are happening at the same time. This kind of alignment does not occur often, and when it does, it tends to produce movements far larger than any single force could create on its own. Add to this a rising sense of caution around global tensions and political uncertainty, and the appeal of gold as a safe and stable asset grows even stronger. Investors around the world, both large institutions and everyday individuals, tend to seek shelter in gold and silver during periods when confidence in political and economic stability begins to waver, even slightly. None of these three forces, on their own, would likely be enough to create a $5 trillion shift in value. A weaker dollar alone might cause a modest increase in metal prices. Lower real yields alone might attract a smaller wave of new buyers. Central bank purchases alone might quietly support prices without drawing much public attention. But when all three forces arrive together, reinforcing each other at the same time, the result becomes far more powerful than the sum of its individual parts. This is precisely what unfolded in recent months. Three separate, seemingly unrelated developments quietly lined up at the same moment, and together they helped ignite one of the most significant precious metals movements in recent memory. Understanding this convergence is essential because it reveals that this shift was never random. It was the product of several long-building pressures finally meeting at a single point in time. While gold often receives the most attention in conversations about wealth and safety, a closer look at the numbers reveals something surprising. In this recent surge, silver actually outperformed gold, rising nearly 19% compared to gold's 15%. For those who study these markets closely, this was not entirely unexpected, but it did reveal a story that deserves far more attention than it typically receives. Gold and silver may often be grouped together, but they behave quite differently beneath the surface. Gold is primarily viewed as a store of value. It sits in vaults, central bank reserves, and jewelry boxes, valued mainly for what it represents rather than what it produces. Silver, on the other hand, lives a double life. It is both a store of value and a critical industrial material, and this second role is becoming increasingly important. More than half of global silver demand now comes from industrial use, and some estimates suggest that figure is closer to 60%. This is a significant detail because it means silver's value is no longer driven only by investors seeking safety. It is increasingly driven by industries that require the metal simply to continue operating. Consider where silver is actually used. It plays a vital role in the infrastructure behind artificial intelligence, including data centers and advanced computer chips. It is essential in solar panel production and the ongoing expansion of electrical grids around the world. It appears in electric vehicles, advanced automotive systems, and the growing rollout of fifth-generation wireless networks. These are not small or shrinking industries. They are among the fastest-growing sectors in the global economy today. There is also a quieter, less discussed use for silver that carries its own weight. Modern defense systems, including missile technology, rely on silver as a critical component. As nations work to replenish military supplies in an increasingly uncertain world, this demand adds yet another layer of pressure on an already tightening supply. This is where the story becomes especially important to understand. Unlike gold buyers, who can often choose to wait for a better price, industrial buyers frequently cannot afford that luxury. A technology company building data centers or a defense contractor fulfilling a critical order cannot simply pause production because silver prices have risen. They need the physical metal to keep their operations moving forward, regardless of cost. This creates a very different kind of demand, one that does not slow down simply because prices increase. At the same time, the global supply of silver is not expanding quickly enough to match this rising demand. Mining new silver takes years of planning, investment, and development. It cannot be increased overnight, simply because prices have gone up. As a result, the world now appears to be facing a growing gap between how much silver is being produced and how much is actually being consumed each year. This gap is often referred to as a structural supply deficit, meaning it is not a temporary imbalance that will correct itself quickly. It reflects a deeper, ongoing mismatch between production and demand, one that has been building for several years, and shows little sign of reversing in the near future. When industrial buyers, who must purchase regardless of price, compete for a limited and shrinking supply, the natural result is upward pressure on prices that can persist for a long time. This is very different from typical investment-driven price increases, which can fade quickly once sentiment shifts. Industrial demand does not disappear simply because a headline changes or a market becomes nervous. This is why so many analysts have started to view silver differently than they did even a few years ago. It is no longer seen simply as gold's quieter, less glamorous companion. It is increasingly viewed as a critical material sitting at the center of some of the most important technological and industrial developments of this era, all while facing a supply problem that cannot be solved quickly.